$1 million regional property versus $1 million metro property. Now, if you're just starting out in the commercial property space, coming in from residential, and you've got $200,000 to $400,000, you're looking to buy somewhere between $800,000 to probably around $1.1 million as your first commercial property purchase. Now, they may seem very, very daunting. That might seem a large purchase to you, because when you look at regional residential properties, they might be between $300,000 to $500,000. However, in the commercial property space, $800,000 to about 1.1 is just your starter property. So you're actually starting at the bottom of the pyramid. At the top of the pyramid, you've got 30, 40, $100 million properties, unlike in residential where, $100 million properties or 2 or 500 are very rare. In commercial, they're just your big size office buildings or shopping centers. So that gives you a bit of perspective. So why would you choose a regional property versus a metro property? If you're looking at the market and you're thinking, which way should I go? What's my current circumstance? What's going to give me the best cash flow right now, as well as the best capital growth in the next 3 to 5 years? And this video is for you. I'm going to cover what's in regional, what's in metro, at the $1 million mark that you could buy, and that which one should you be going for depending on your situation, but also, if you stay to the end, the pitfalls of what not to buy in each area. My name is Helen Tarrant. I help everyday Australians become wealthy in investing in commercial property, and I'm going to do the same for you as well. If you're interested in finding out more, there's a link below to booking for a strategy session. Let's get started. So, you want to buy $1 million property, but you actually don't know what you're looking for. So you're thinking, I would like some cash flow, I would like some growth, something in middle of the road, because that's what the market teaches you in residential, and that's completely wrong in commercial. Commercial, you've got to start with a big picture. So how much do you want to retire with, and then work backwards. If you don't know and you're just canvassing the market, you're trying to find the best value. Now, I'll give you a quick tip here. The best value is to find a property that does exactly what you want it to do. So if that is cash flow, then do the cash flow deals. So what does that mean? That means going to regional areas and searching for cash flow. Put growth on the back burner and actually focus on cash flow. If you're looking for a property that has growth, and that's really important because you don't need cash flow today, then you need to forget about cash flow. Don't even look regional and just stay in the metro areas. So on that said, what can you get for $1 million in regional versus $1 million in metro? So let's have a look. In regional, $1 million can still, depending on where you got, buy you a freestanding property. This property here is a freestanding warehouse. It has a bit of a showroom at the front, and it has basically a workshop shed at the back. Now, there's other properties like that where it's freestanding. It might be a medical clinic. So it might be an old residential property converted to a medical clinic or allied health, or it might be just this standard kind of warehouse or a freestanding building. So these are the properties you are going to get in regional, in large regional towns. The yield is going to be probably between 6.5% to about 7.25%. Now, when I talk about yield in commercial property, it is net yield. That means it's after all the outgoings are taken out. So that's management, land tax, insurance, all of the outgoings have been taken out. And what comes back is the net rent before mortgage, because everyone's mortgage is different. You take out the mortgage and the rest of the cash flow is for you to keep, and that is your positive cash flow. So in regional, you are buying these type of properties where typically it's on a little bit of parcel of land. You might be as small as 400 square meters or as large as 1,000 square meters of land, and you've got a freestanding building on it. People might use it for a training center. It's often a little warehouse with a showroom, but it can also be a freestanding allied health clinic as well. So these are the type of properties you are going to be looking at and buying 6.5% to 7.25% yield. Now, of course, this depends on where you go. If you go to a large regional town over 50,000 people, somewhere like a Bundaberg, somewhere like a Townsville, somewhere like a Rocky, somewhere like a Cairns, or somewhere like a Mackay, those areas, or if you go down south, you're going to somewhere like a Warrnambool or a Wagga, those areas there are going to have sharper and lower yield. So they're going to average out around that 6.5% towards that 7% yield. Now, if you go inland into the much smaller areas, so areas that is like inland from Sunshine, inland from Gold Coast, so your Kingaroys, your Mullaneys, and if you go up, you go into your Gympie's, and you go more inland, you go into your Emeralds, all those areas where we're far away from the coast, your risk level starts to go up, and with risk, and because the population is smaller, your yields also go up. So this is where you start to hit above sevens. So you need to start your number at 7, and you'll start going up, 7.25, 7.5, upwards and upwards, right? If you're going to be buying in a mining town somewhere like Gladstone, you will want above 7.5%, maybe preferably towards your 8% mark. Now, if you're in a truly mining town, where somewhere like an Emerald, somewhere like a Mount Isa, where it's truly mining, Kalgoorlie in WA,
these are the areas you're going to be going 8 to 9% yield. So really, really high yields. But remember, with high yields come less growth. So if you're buying in regional areas, these areas don't have the same growth as you do in metro areas. Now, having said that, the last 3 to 5 years, we've had massive growth in regional, and that's because people who can't afford to buy in metro areas have moved to regional because they needed the cash flow. So regionals already had that run for the last 3 to 5 years. You've got to think about whether you want to be part of the tail end of that run, or you actually want to be the start of the run of capital growth. If you want to be at the start of it, this is where we switch to a metro area. Now the interest rate is coming down. With the interest rates coming down, you are going to be likely to be neutral and positive buying in a regional area for commercial property. Now, how is that and how does that work? Well, remember, commercial property, the tenant pays all of the outgoings. Well, in this area, your tenant is basically paying you $60,000 on every $1 million, which is a 6% yield in metro area. That is about the best you can get in a metro area right now. If you want to have tenants who are allied health or medical type tenants, they're very secure, but you're trading off that security for yield, right? Yield is the ultimate decider of security. If you want more security, less yield you're going to get, right? So the more you get of security, the less yield. So you want something in Metro Sydney with a medical tenant, that yield is going to be 3 to 4%. If you want something that is even better, like maybe a childcare, a medical center on very long leases, it's going to be lower around that. Even somewhere in Sydney have been trading, like Chemist Warehouse has been trading at 2% yield. So what kind of yields are you getting in Metro if you're a starter investor? You need to aim towards 5.5 to 6%, right? Anything below that, you are not going to get the benefit of capital growth in the future. And plus, you're not really going to be able to grow your portfolio if you go any lower than 5.5%. So 5.5 to 6%, it is your benchmark if you are in metro areas trying to grow your portfolio and you're starting out. So between $800 to $1 million, the type of property you're going to get are these retail shop fronts are pretty much the most popular. They're going to have one kind of tenant in there, either professional or they're going to be more hospitality retail tenants. So there may be a cafe, there may be a dentist clinic, right? There may be H&R Block. They may also be like training facilities. There might be media companies. All of those, lawyers' office, accountants, they're all part of that retail space they can be in. Now, government tenants can also be in those retail, NDIS tenants can also be in that retail space. The next level up is looking at office spaces. Office spaces go in metro areas right now can still give you a slightly higher yield than your retail shop front, so you might expect 1/4 or 0.5% higher. So if you're getting in at 5.5 to 6%, somewhere in the office space market, you're getting around that 6 to 6.5%, preferably with a good solid tenant. So the tenants there are likely to be your IT type tenants. You're going to be your professional tenants, accountant, wealth managers, and lawyers. They're going to be like that type of tenant. But you can also have government tenants up there. There's a lot of government tenants, a lot of medical allied health tenants, psychology clinics are also up in those areas as well. And I've even seen childcare in office spaces. So it depends on how big or small you go. Obviously at $1 million, you're looking at those small to medium sized businesses who are operating out of those premises, and they're going to be a metro area. When I talk metro, I mean Sydney, Melbourne, Gold Coast, Brisbane, Adelaide. Adelaide, you want a little bit more. ACT. These are the areas you're looking for on the East Coast, right in the heart and the suburbia. So you're not looking at CBD Sydney, CBD Melbourne, you're looking at the suburbs around there. Those suburban areas are the ones that have like very low vacancies and they have good value and they continue to grow in value in the future. So those are the properties you would look at. What about warehouses? Well, if you want to do an industrial warehouse that is in $1 million range, those things you definitely get in metro areas, but they're going to be part of strata. So everything you buy in a metro area is going to be strata. So in regional, you're going to be able to get freestanding, but in metro, they're going to be strata properties. Now, warehouse properties have had their run in the last 3 to 5 years. Are they going to have more growth? Yes, a little bit more, but again, the yields have compressed a lot more. So if you want to be in a industrial property that's around the $1 million mark, you're going to be looking at about 5.5% and maybe slightly lower as well going forward. So on that note, what do you do? Right, so if you are looking at buying regional or buying metro, my biggest tip to you is look at what is the most important thing for you. Is it cash flow? Is it growth? If it is cash flow, then what you want to do is look at regional areas rather than metro. So you go there, you'll break even on everything. So if you're doing 100% finance, so drawing down the equity from your principal home or another investment and using that as a deposit. So there's a cost of the deposit plus the cost of the loan. So 100% finance. Some people are 105% finance because they're also financing your stamp duty and cost and everything else. In that circumstance, all of that is needing to be covered by your new property. That has to be a regional property. Don't even think about a metro property. You are going to be negative in a metro property by about $10,000. Now, what you want to avoid in a regional property is properties that are your strata properties, maybe your strata retail or your strata office spaces. Those are really for $300,000, $500,000, $600,000 purchases. If you're in the $1 million range, what you really want to do is push a little bit more, maybe go to 1.1 and try to get a freestanding property. Otherwise, you might as well be back in metro. So try to avoid those and also try to avoid properties that have already an inflated rent or the rent's already gone up, because those are going to be really hard for you to sustain that rent when you re-tenant, but also it impacts on your future value of the property. So that in regional need to really look out for it, but also don't get suckered in, and people do this all the time, by the amount of land that you get in regional. The land in regional is not worth anything compared to metro land. So people go, oh my God, I want to buy that property. It's so great. It doesn't matter. I'm going to accept a lower yield because it's on 2,000 square meters of land versus my 400 square meters of land that I could be buying for the same value. But I'd rather go a little bit further out regional and get that piece of land. The land is worth zero, and it's worth very, very little. I wouldn't say zero, very, very little compared to having 2,000 square meters in a metro area like Sydney, Melbourne, or Brisbane. So you've got to get it into perspective, because remember, you're sitting back from your seat in a metro area and doing investing, right? So don't be fooled by that. Now, coming back to metro areas, if you are looking for a property that has growth, if you're putting in cash, then you want to stay in your metro area. So why? Because if you're putting in cash or partly cash, partly equity, so let's say you needed $400,000 to buy 1.1 million and 200,000 was cash and $200,000 was equity, you want to be buying in a metro area, because the swings, we're about to swing back as the interest rate comes down. More and more people are going to switch back to metro because they can afford to buy in metro. It's going to push the prices up. So you want to get ahead of that curve, and you want to sit there and buy those metro properties. Now in metro, don't even think about going and buying freestanding for around that $1 million mark. You can buy freestanding, but you're going to take 1 to 1.5% hit on your yield. So instead of getting 6%, you're going to be paying about 4.5% to 5% for a property that is freestanding. What for? Because you're thinking you're going to get more growth because you're buying $1 million, a little wedge of land for 5%, you're taking a hit on the yield. Well, you'll be barely breaking even and probably negative for the next couple of years. No point. You're going to get your same growth for your commercial property, whether it's strata or non-strata, regardless of whether you're buying a land or no land. And the reason for that is because ultimately, right, when you people who are buying at that lower level, so when your property's gone up in the next 3 to 5 years, 1 million might become 1.2, 1.3, 1.5 in 5 years time, you're going to find that people coming into the market in a metro area can't afford freestanding anyway, so they're going to be buying strata. Yeah, so don't worry about your growth. Your growth will come because the wave of people underneath you could only afford strata. They're not going to come in and buy freestanding. Those people buying freestanding are spending 3 to 5 million anyway, so they're not your target market. So you will still get your growth in strata. It will be just the same as a property that's freestanding. Sometimes will be even more because it is more affordable, because it's all about affordability and catering to the masses when you're in that introduction property, right? So coming back to it, what is there to avoid if you're going into metro areas? Please try to avoid those new developed places where you've got still a lot of vacancies and the developers are giving you guarantees. No, that's number one. Number two, avoid things that are too small square meters or things that are in a weird area you can't get access, because remember, it's all about access, right? The access gets you to the next level, right? So when you say access, what I mean by access is like, does it suit your tenant, right? Can your tenant park at the front? Is there parking underneath for visitors? Is it easy for them to see the exposure of it, right? So is it that they can see the exposure in terms of, okay, if people are driving past, can they see that it's a dental clinic? Can they see it's a vet shop? Like, is that exposure important? So you look at all of those, and also foot traffic is really important. So ability those things that are, that are hidden at the back, even though it's really high yield. Avoid those things where you have access issues, and do also avoid things where, the property itself can't be changed to anything else. So you can go from retail to office tenants to maybe even your allied health. You want to look at as much as versatility as you can building into your property. And people make that mistake because they look at a brand new building, think, great, wow, fantastic, it's brand new. Secondly, oh wow, that's so great because I'm getting a developer's guarantee or a rent for 2 or 3 years or even just 1 year. The market's going to change, but they don't understand that the supply of additional stock is going to inhibit that. So make sure you don't make those mistakes. Remember, my name is Helen Tarrant, and I want to invite you to a special webinar that I am running about commercial property. The link is below. Make sure you click the link and it will take you to the next available webinar that we have. So I look forward to helping you in your commercial property journey and transitioning from residential to commercial so that you can get better returns and that you can retire sooner, faster, and better. Thank you very much. Hit the subscribe button and I will see you on the next video. Bye for now.